recording. All right. So when we're looking at accounting, the thing that you've got to get your head wrapped around is there's something happening right in front of you. Okay. And the trick is that accountants look at something that's happening right in front of us, and then we have to sort of distill it down into some very basic information, and we've got to get it recorded. Okay. Now, think of the way that we're doing this is you're walking around with your phone all day. And imagine that with your phone, you're basically recording every single transaction that you are participating in, whatever that might be, right? So you buy Coke, you write it down. I bought a Coke and it was this much money. You know, you went to the food court and you bought lunch, okay? Bought lunch and it cost me this much. And you're recording all of that in your phone, okay? Now imagine that your phone is what we call the general journal, all right? So the general journal, okay, in chapter, basically in chapter 2, we start with that journal. Now, one of the things that I just realized is we probably should back up one step, and let's actually look at this one first. All right, so that we can actually sort of get the idea of what the big picture is, because this slide right here is basically all those financial statements from chapter 1. Okay, now notice what's happening. So in chapter 1, we learned that assets equal liabilities plus owner's equity, right? That's the balance sheet. Okay, now as we break that balance sheet down and we break this equation down, we've got assets, we've got liabilities, and we've got equity. Now, the big trick on learning debits and credits, number one, is debits and credits do not mean add and subtract. They never have and never will, okay? You would hear that in my lecture videos, integrity. They never mean add and subtract, although people use them as if they mean add and subtract. Debit and credit simply means to the left and to the right, okay? So debit means to the left. So a debit to assets is actually going to increase an asset account. A debit to a liability, though, is going to decrease the balance in a liability, and a debit to equity is going to decrease an equity account, okay? A credit simply means to the right. So if we put something, these are our T accounts, right? So if we put something on the right for an asset, or on the right, we're going to subtract a credit and an asset, but we're actually going to add credits on liabilities and equity. Now, don't let this be too difficult for you, okay? This whole concept of debits and credits is real simple to sort of get your head around if you'll get off of that train of they mean add and subtract, because they don't, okay? Assets are on the left-hand side of the equal sign, so they increase on the left. Liabilities and equity are on the right-hand side of the equal sign, so they go up on the right. So then those are the sides that go up, the opposite side must go down. Any questions there? Okay, so when you're looking at that aloe red document, aloe is assets, liabilities, and owner's equity. Okay, all right. So that's where you start with aloe, A-L-O-E, okay? When you're looking at assets, from this point down, now we're sort of trying to look at them in terms of, we're going to look at a little bit more debits and credits, but in chapter 2, all we're looking at is transactions that affect balance sheet accounts. So in chapter 2, we looked at transactions that affected assets, liabilities, and stock. Okay, that's it. Okay, then we also learned that assets and liabilities can have current assets and non-current assets. Liabilities can have current liability, current liabilities. Okay, the only difference between these two is on the asset side, when we're talking about current assets, that means that those assets are either going to be used up or turned into cash within the next year. Okay. Everything else that's listed in non-current assets just means that it's going to be they're going to be used up in more than a year. So an example of a current asset, which I should add maybe another little row down here, that'd be good. A current asset would be things like cash, accounts receivable, inventory, supplies, and some of the things that we've been looking at as far as prepaids is things like a prepaid advertising, prepaid insurance, and prepaid rent. Okay, we'll talk about what those are here in just a minute. All right, then non-current assets are going to be things like automobiles, computers, equipment, buildings, land. Those things are going to be used for much more than 1 year. So that's one of the big things there on current versus non-current assets. Okay. Any questions there regarding assets? Okay. All right. So let's talk about liabilities. All right. So liabilities also have this current and non-current aspect to them. Okay. So liabilities are going to be things that we have to settle up within the next year. Okay. Non-current liabilities are things that we're going to settle up in more than 1 year. Okay. So a current liability would be something like accounts payable. Those are things that those are amounts that we owe somebody that we're going to have to pay off generally within the next 30, 60, 90 days when you see accounts payable. Then we've dealt with things like notes payable. Notes payable, we've dealt with aspects of them being short-term versus long-term. Those short-term notes payable, we're going to have to pay those off within 1 year. So those are also current. Okay. The other current liability that we've looked at so far is a liability called deferred revenue. Okay. Now, one of the things to keep in mind about deferred revenue is simply this. Think about what that word deferred means. Okay. Deferred means we're putting it off. Okay. So when we've got deferred revenue, what we are deferring is recording it on the income statement. So a deferred revenue is a liability, but it's not going to be settled up by us paying cash. It's a liability that's going to be settled up with us having to go out and do some work for somebody or provide them with some type of product. Okay. So all those are current liabilities. Then at this point, the only non-current liability that we've looked at so far is a long-term note payable. Okay. So that would be a loan from the bank that maybe we're going to pay off in 3 years, something like that. Okay. And then again, in chapter 2, the only other thing that we looked at was common stock. Now, again, keep in mind that we're still over here on the now we're shifting over to the equity. Now, the equity section of the balance sheet is a little bit more challenging because it's got so many pieces to it, okay? So watch how these pieces fit together, all right? We've got equity in general. Equity is made up of two big pieces. We've got stock and we've got retained earnings, okay? Now, within this stock realm over here, the one that we're going to deal with in this class is common stock, okay? So if we write, so if we put something in a common stock account, it increases stock and it increases equity because all of this rolls up into equity, sort of here at the top of the pyramid, if you want to think of it that way, okay? So again, in chapter 2, we dealt with these pieces right here: assets, liabilities, and stock. That's it. When we got to chapter 3, we added this whole concept of retained earnings, revenues, expenses, and dividends. Okay? Now, stop and think about how all this plays together, right? We start with the income statement, right? Revenues minus expenses equals net income, right? Then that net income rolls into the retained earnings statement. We then subtract dividends to get to ending retained earnings. Then that retained earnings rolls up into the balance sheet. Now, look at it from just a different perspective. Here's the income statement. That rolls into the statement of retained earnings, which would include all three of these, right? We would start with beginning retained earnings plus net income minus dividends gets us ending retained earnings. Okay, then that retained earnings statement rolls up into the balance sheet to balance the balance sheet. Okay, so that's how all this stuff fits together. All right, so let me get back to the balance sheet. Okay, so then you've got the balance sheet. Everything's rolled up there, it balances. That means that we are good to go. Everything should be correct. Okay, then when we're talking about the cash flow statement, we're just simply coming up here on the balance sheet. Think of the cash flow statement, so it's sort of being off to the side of the balance sheet, and we're now proving that this $13,000 cash balance that's right here actually is $13,000. And we're simply taking all these things, these different groups here on the cash flow statement, and we're showing how we got 13,000. So we started with 0, we added a net 13,000, and this up here is how we got it. All right. Now, on the cash flow statement, you've got 3 different groups of cash flows. You've got operating activities. Those are revenues collected from customers and expenses paid to employees and suppliers. So this operating activity are payments and receipts that affect the income statement. Okay. Then you've got this whole group, this next group called investing activities. Now, you know what it means to invest in something. You're investing in some kind of asset. The trick is here on investing activities is this is basically investing activities where we are investing in long-term assets. Okay? Long-term assets, because we'll look at it here in just a minute, but a lot of those short-term assets are actually revenues and expenses that we haven't either collected them yet, or we haven't used them yet as an expense. Okay. All right. So there's investing activities. Then you got financing activities. So now financing activities, now we're over on the liability and equity side of the balance sheet. And we've either issued stock, paid dividends to stockholders, or we've borrowed money from the bank or paid back money that we borrowed from the bank. So when we get down here to financing activities, we're on the liability and stock side, and it's back and forth from the stockholders, back and forth from the bank. The only exception here is when we're talking about money back and forth from the bank, anything that is interest on a loan would be up here in operating activities, because that would be considered interest expense. And anything that's a revenue or an expense has to go up here in the operating section of the cash flow statement. Okay. All right. So again, here's the view, right? This yellow box, that starts with the income statement. Then we're dealing with the retained earnings statement. All those items there. Then we roll up into the balance sheet. So now we are up here, letting everybody know current, non-current, current, non-current. How much stock do we have? How much retained earnings do we have? Okay. So it all flows together and everything rolls up to the balance sheet. Okay. Then there's our cash flows. Right. Okay. All right. So let's start there. That's basically a really big review of a lot of chapter 1 and chapter 2. All right. Now, that's the big picture. And maybe a little bit of chapter 3 as well, because we did get into the income statement. But that's the big picture view of what just happened in chapters 1, 2, and 3. Okay. Chapter 1, we learned about all the financial statements. Chapter 2, we learned about asset, liability, and stock. And then chapter 3, we learned about transactions that affect revenues, expenses, and dividends. Okay. So at that point, we've completed all the things that hit the balance sheet. Okay. Now, that being said, now let's drill down into what is happening. Okay. So again, let's go back to that scenario where I was talking about carrying around your phone, you're recording all the transactions that things that you've spent money on during the day, things, somebody gave you money, we're to write that down, who did it come from, what was it for, all that kind of good stuff. So, if it was from your employer, we would write revenue. If we had to pay for lunch, that's an expense. If we had to put gas in our car, that's an expense. And we're writing all that down on our phone into something that would be considered something along the lines of what we call a general journal. Okay. So then that is essentially the process of posting to the general ledger. So now the computer is completely up to date with, what cash did you collect today? What cash did you pay out today? Did we earn a paycheck today? Did we go to the store and put something on a credit card, right? So those are the things that you're doing on your phone. You come back, you sync it with your computer. All right. That syncing process is basically the posting to the general ledger of all those transactions that were on your phone. You got the visual there? Give me a thumbs up or a okay or a got it in the chat, something. Let me know if you got questions.
I have a question for the exam.
Okay.
So this the journal setup, the journaling
Yes.
when it comes to you know how during the quizzes it had um a little exercise where we would kind of we would kind of journal like that, like the retained earnings, etc.,
Uh-huh.
in its place. Would that initially be on the exam, like where we'd have to do an exercise like that?
Yes, and I'm getting ready to show you how to sort of get those journals and those journal entries sort of straight in your head.
Okay.
That's where we're going next. Okay. So at this point, that, what we just did was big picture. All right. So now let's dig deep down into what we're doing. So keep in mind, again, let's sort of stay in the big picture here for just 1 minute for me. All right. The accounting cycle has 3 rounds to it. Okay. You've got daily journal entries, posting those daily journal entries, and then preparing an unadjusted trial balance. This happens on a daily basis, day in and day out. Okay. It's the only thing that happens. Then we've got round 2. Round 2, at the end of each month, we're going to have to make adjustments because once we get into round 1, you're going to see there's just some things that we've got to get them these items recorded, but based on what we do on a daily basis in the accounting department, there's just no way to get that recorded unless we just sort of stop at the end of the month, evaluate what's there, and make sure that we've got proper balances in the accounts. Okay. So round 1 happens on a daily basis. Round 2 happens on a month end basis. Okay. We're going to make month-end journal entries. We're going to post those to the general ledger. The same general ledger, by the way, that the daily entries are posted to. So this general ledger is, think of a general ledger like a notebook with tabs in it. And every cash entry that we make over here in the journal has to go into the ledger on the cash page, right? Things like that. Okay. Then we're going to prepare what we call an adjusted trial balance. So when we get to the point of an adjusted trial balance, we know that we've got valid amounts, that we are now ready to prepare the financial statements, right? Then we're going to start with income statement, statement of retained earnings, balance sheet, cash flow. Okay. So that's at the end of each month. Okay. Then once a year, we've got to do closing journal entries. Now, this closing process is just 2 journal entries. We'll look at those here in just a minute. But this 3rd round only happens once a year. All right. Are you with me? Okay.
Yes.
All right. So let's take a look at what happens on a daily basis in the accounting department. Okay. Again, stay big picture. Don't look at the journal entries. Big picture. We are recording cash receipts. Ready? We are invoicing customers or billing customers. And we are recording invoices from vendors. So people that we've bought stuff from, they've now invoiced us. Okay? Real simple process here. There's only 4 things that we do in the accounting department on a daily basis. Okay? Now, this is where we're going to dig deep. That cash receipt. We made it, cash came in, checks came in, we took them to the bank. Now the question becomes, what were those cash receipts for? Okay. Was it an accounts receivable? Well, think about what's happening there. If that was accounts receivable, that means that we previously went out, made a sale to a customer, and they just simply haven't paid us for it yet. Now they've paid us. So we would reduce the accounts receivable and collect cash. Okay. All right. Another way that we can get cash back into our business is we can sell some sort of long-term fixed asset, like equipment, buildings, automobiles. We sold that, we collected cash. Another way that we can get cash is we went to the bank and we borrowed money. So there's our notes payable, right? And you see the description now here next to it, okay? We could have issued stock and collected cash. We could have earned some revenue and collected cash at the same time. So we work for the little handy mart down at the corner. We handed somebody a candy bar, they paid us for the candy bar, right? We gave them the item, they paid us cash. We earned revenue at the same time that we collected it, okay? Then we've got the possibility of deferred revenue, okay? Deferred revenue, okay, is the collection from a customer for a future sale. Now, don't make this concept too hard. This occurs right here. If you look at it from the customer's perspective, not the company's perspective, or actually look at it from the company's perspective. I'm your customer and I come in and I buy a gift card from you. You're going to record deferred revenue and you're going to record the collection of cash. That gift card that I bought from you, you're not actually going to earn that revenue until I come in on a different day and use some of that money off of that gift card. Are you with me?
That makes a lot of sense.
All right, perfect. Okay, so basically this is cash receipts. This is all the ways that we can collect cash. Okay, all right. The next thing that we do on a daily basis in the accounting department is we write checks. We got to pay bills. We got to buy stuff. All right. So every single time we do that, we're going to have a credit to cash. I didn't even mention that up here, right? When we collect cash, it's always a debit to cash. It's just a matter of what the credit goes to, right? On a cash disbursement, every single time we disperse out cash, it's a credit to cash, reducing cash, and now we just got to figure out what the debit's for, okay? So when we write checks out, then the question becomes, what was it for, okay? We could have bought a long-term fixed asset like equipment, buildings, or autos. We could have bought something like inventory, supplies, or we could have a prepaid asset. Now, I think these 5 right here probably make a little bit more sense. So let's talk about what a prepaid asset is. You guys drive cars, right?
Yeah.
All right. You pay insurance? I hope so.
My mom does.
Okay. All right. Now, stop and think about this. When you buy your insurance for your car, most people pay their car insurance once every 6 months for the next 6 months. So let's say I'm the insurance agent. You write me a check for insurance for the next 6 months. So that means that you just wrote me a check for 6 months. So February, March, April, May, June, and July, right? And let's say it was, I'm just going to come up with some numbers that are really simple. So let's say that you wrote me a check for $600. Okay. Now, this is from your perspective. I'm the company. Okay. I'm the one recording the prepaid asset, but I'm just trying to get you in the feel for it. You just wrote me a check for $600 today. Have I earned any of that $600 today when you wrote me the check?
No.
No.
No, right? I have to provide you with insurance coverage to earn that, correct?
Right.
Okay, so now let's flip it. You're the insurance agent, okay? Now you're looking at it from the insurance agent's perspective. I write you a check for $600. At the point where I write you a check for $600, right? You're now going to record deferred revenue and you're going to collect cash. I'm writing you a check and I'm going to record prepaid insurance. If I'm the insurance agent, you just wrote me a check for $600. You're going to record prepaid insurance. From my end, I'm going to collect your cash and I'm going to record deferred revenue because I now owe you 6 months worth of insurance coverage.
Okay, but that can happen like that can happen in the same day, like, right? If
Yes.
you okay.
Yes, that would happen in the same day. That is correct.
Okay.
All right, you see it? You're collecting, it's like, just depends on who, if you're the insurance agent or I'm the insurance agent, right? But if you are writing the check, right? You're reducing your cash and you're recording a prepaid asset called prepaid insurance. I'm collecting your cash and I'm recording a deferred revenue, okay? Both for $600. Now, think about what's happening there. At the end of the month, when this prepaid asset called prepaid insurance, when I've provided you with the insurance for the month, now we got to get it out of the prepaid asset and into insurance expense, right? From your perspective. Do you see it?
I think so.
All right. Let's look at it from one perspective then. Okay. You wrote me a check. All right.
Okay.
You wrote me a check. We're only looking at it from your perspective. You reduced cash. You recorded prepaid insurance, right?
Right.
Now, end of the month. It's the end of February. You've used 1 month of that prepaid insurance or $100 of it, right?
Right.
Now we got to reduce the prepaid insurance by $100. And now we got to record an insurance expense because you've actually used up $100 of that insurance.
Oh.
Oh, that's a good light bulb. I like that.
Okay.
You got it?
I
How's
think
everybody
so.
else doing? Okay.
Sense.
Okay, good. All right. So there's prepaids. All right. Then maybe we paid, another use for cash. Maybe we I can't talk now. We wrote a check and now we're paying down accounts payable. So maybe we bought something on our credit card at Office Depot last month. Now we're paying down that credit card is essentially what that could be. All right. So now what we owe Office Depot is now less. Okay. Or maybe we paid down the principal on that note that we borrowed from the bank. Or maybe we paid out dividends to stockholders. Or maybe we paid out, let's say we're a construction company and one of our guys went to the gas station and filled up their truck with gas, right? At the same time that we actually pay for that cash, we're using the gas immediately. So we record the expense immediately. How are we doing?
It makes sense.
Okay. All right. So there's two aspects of what we're doing on a daily basis. We're receiving cash and we are paying out cash. We just got to depend, it just depends on what we're receiving that cash for or what we're paying it for. Okay.
So will you have like a total amount for the cash and then you just add in all of the debits or whatever and then you subtract all of the credits like the purchases?
Yes. So on an ongoing basis, cash has an ongoing balance. So every day we add the deposits, we subtract out the checks. The next day we write, we make more deposits, we subtract out the checks we've written. The next day we record the deposits, we subtract out the checks that we've written.
Okay, that makes sense.
Okay. All right. Okay. So those are two things that we do on a daily basis in the accounting department. Okay. The other two things that we do on a daily basis in the accounting department is we bill customers. Now, here's the great thing about billing customers. It's this same journal entry every time, because all we're doing here is we are sending them an invoice. We have either provided them with some kind of service, or we've provided them with some kind of product, and now we've got to record the earned revenues and the fact that they now owe us for that service or product. Okay. So we're going to book the accounts receivable saying that they owe us, and we're going to record sales or service revenue. If it's sales revenue, that's product. If it's service revenue, that's basically we're selling them our time. Okay.
Yeah, it's more so. It's not that I don't understand the accounting language, but then it's like I don't understand the accounting language because of the vocabulary more so.
Right.
That's pretty much it.
Yes. Well, I tell you, one of the things, part of the reason why we do those attendance quizzes and they are vocabulary tests is because folks don't want to learn the vocabulary, and that's where we got to learn the vocabulary. Otherwise, we're looking at something that we can't even understand. I mean, that's part of the reason why accounting is so challenging. Number one, it's a little bit like a foreign language. It's a language that you haven't really been exposed to yet. It's also not a math class, it's a logic class. And everybody wants to make it into a math class, and it's not really a math class.
Oh yeah, that's what I went. I went in thinking that.
Yep, a lot of people do.
Because like just, and this is not really too much off topic, but when you think about like being logical in like comparing it to a subject, math would be the most logical thing, so it would compare like that.
Yeah, but call it this. Accounting is like the world's biggest, what was the word I'm looking for? It's like the world's biggest word problem.
Yeah, I got that.
It's the world's biggest word problem, right?
Right.
Which everybody hates, by the way, so we own it. We know. All right. So everybody good with billing customers, right? We've just the deal is we've just provided a product or a service, and we're recording the accounts receivable. Okay. All right. Then the fourth thing that we're doing in the accounting department is we're recording invoices from vendors. So where our vendors have actually been, we're buying from them, they're billing us. So they're recording this journal entry on their end. We're recording something like this on our end, right? So now we owe them, they're recording an accounts receivable, and we're recording the accounts payable. Now the trick is when we buy something on credit, which is exactly what we're doing here, we've got to record the accounts payable because now we owe somebody. Now it just depends on what did we buy. Did we buy some kind of long-term asset? Did we buy some sort of short-term asset? Or did we incur some kind of expense? Yes. Sure, go ahead.
So when it says like inventory and supplies, like when we were doing like homework and quizzes or whatever, do we just assume that we purchased the supplies? Because sometimes it just says supplies and I can't tell if we purchased them or if we like sold them.
Okay. If it says something along the lines of, we wrote a check for supplies, if we're being billed for supplies, something along those lines, or I'm trying to think of how they might word it without using the word purchase. That's probably the two biggies. We either we wrote a check for supplies or something along those lines, or what was the other one? Boy, that just fell right out of my head. See, we wrote a check for supplies, or we I don't want to use the word incurred.
Build. You said build.
Yeah, or the customer billed us for supplies. That's going to be about the only two things there where we would, if they said that we wrote a check for supplies, now we're up here in number 2, right? We've got a cash out, and we're going to record the supplies in the asset, okay, account. If it says that we purchase supplies on account, this is where we are down here. Or if it says that we took possession of supplies on account, I'm trying to think of other ways to say it without using the word purchase, since the purchase thing is throwing you off. So the big thing here is if we buy supplies on account, we're down here, accounts payable, and we're recording the asset. If we write a check for supplies, now we're up here under cash and supplies. Okay. Now, if it says in some of those problems, it could say something along the lines of, we had beginning supplies of 0. We bought $500 worth of supplies, and we have $300 worth of supplies left. Well, if we started with 0, try to imagine a supply closet. When we buy supplies, we throw them in the supply closet. So if we bought $500 worth of supplies, we put all $500 worth of supplies in the supply closet. If somebody walks back in there at the end of the month and says there's only $300 of supplies that are left in the closet, we had to have used $200 worth of supplies, right?
Right.
Right, that makes sense.
Okay. All right. So that process is going to happen down here under round 2. Okay. But is everybody good with round 1? Right? We're collecting cash. What did we collect it? You know, what happened that we turned something into cash? Here, we paid out cash. What did we buy? What was that cash disbursement for? Here, we're interacting with customers, and we're billing them for services that we have provided to them on account. Now, if we provide services and they immediately pay cash for those services, we're now up here under number 1. We would record revenue, and we would record cash. And actually, this could be sales or service revenue, if that helps. Okay. So if we provide the sales or service and we immediately collect cash, we're right here. Okay. If we provide the sales or the service, the product or the service, and then bill the customer, now we're down here first, and then we collect it up here. Are you starting to see how this is all it can be? These 4, basically these journal entries right here on a daily basis. If somebody pays us for the item first or the service first, we're right here. We're starting off with cash, deferred revenue, and then we got to get down here under a month-end journal entry to settle up if they actually used that gift card. Okay. All right. Can you think of any questions here on cash receipts, disbursements, billing customers, or recording invoices from vendors?
I have a question about like when you enter it into a like journal entry or whatever.
Right.
So sometimes when I'm like working on the homework or the quizzes, it confuses me when it has blanks, like slots that you don't fill anything in. How are you supposed to tell what is supposed to say blank and
Yeah.
Well,
yeah, one of the things, especially you'll see that especially within the financial statements, because it'll be things like if you're looking at an income statement, you know, you might have the heading for revenue, and then you got 3 lines below it, and you're thinking, oh, okay, well, there must be 3 different kinds of revenue. Part of what they're doing there is this: you really, at this point, you only have 2 kinds of revenue. You got sales or service revenue, right? You either sell them product or you sell them service, right? So there's only 2 kinds of revenues. The reason why they put that third one in there is they're trying to get you to see whether or not you actually know to leave that deferred revenue on the liability side of the balance sheet, or are you going to try to put it in the income statement?
Okay, that makes sense.
Yep. So there's a reason why those blanks are there. They're testing you to see if you know what to put in there. Other things that on the expense section of the income statement, same kind of thing. Do you know that the only thing that we're going to put there is actually incurred expenses? Okay. So are we going to actually, do we know to just put expenses there versus, right, expenses there, or sometimes they will call these prepaid assets, they won't specifically refer to them as prepaid insurance, prepaid advertising, or prepaid rent. They'll call it a prepaid expense, which is exactly what this is. So that prepaid expense, prepaid asset, it's rent that you've paid in advance, it's insurance that you've paid in advance, it's advertising that you paid in advance, and then we got to get it out of that asset and onto the income statement as an actual incurred expense.
So it doesn't go on the expenses quite yet, not until it's actually like the service has been provided or whatever.
Bingo.
Okay.
Yep, you got it.
Wait,
Okay.
wait.
Okay.
What is this? What she said? What was that pertaining to again?
Okay. When you're talking about prepaid insurance, prepaid advertising, or prepaid rent, right? We're paying those things in advance of their use. Okay. So when we pay them in advance, we book the asset. Okay. And then as we use them, as we, for rent, as we occupy that space, it comes out of the prepaid asset and goes into rent expense. As we use up the insurance, the prepaid insurance, it becomes insurance expense. As we use up the prepaid advertising, it becomes advertising expense.
Okay.
So that's what she's talking about.
And I was a little bit confused as I started to like kind of try to grasp the concept of credits to debits.
Uh-huh.
So can you
keep in mind, and again, this is one of the hardest things. This is that exercise. Have y'all ever done that exercise where somebody's standing behind you and they make you hold your hands out? Like you're in the shape of a cross, and they go, okay, go ahead and fall backwards. I'm going to catch you.
Yeah.
And it takes you a little bit to kind of go, yeah, I don't know if they're actually going to catch me or not. Trust me, I'm going to catch you. Debits and credits, the one thing that you have got to let go of is debits and credits will never mean add and subtract. And that is the most difficult thing to let it go, because I'm going to show you something here in just 1 second. Let me get.
You said debits is left and credit is right. Is that right?
Yes.
Okay.
Debit literally means to the left, and credit means to the right. That is a, well, if I can find my, there we go. That is the big thing that is going to just hang you up if you just don't fall back and and trust me. Let me. There we go. Come on. There we go. Okay. All right. So you should see a blank white screen at the moment, correct?
Yes.
Okay. All right. Now, I want you to think about something here. Don't make this hard. All right. This is what you're used to seeing. All right. I make a $10,000 deposit into my cash account. I write a check for $1,000. Actually, hang on. I'm going to, I'm using accounting stuff, and I want to make sure that I'm not, right? And I write a $1,000 check. I write a $2,000 check. I make another deposit of $3,000, right? And if I asked you to total up that column, it would be, right?
Yes.
Right? Because these are adds and these two are subtracts, right?
Okay, so wait, why would you have $10,000 at the end?
Don't worry about what it's for. Okay.
Okay.
So I'm just saying that it's like, I got a cash account. I put $10,000 in. I wrote a check for 1,000. I wrote a check for 2,000, and then I put another deposit in there of 3.
Okay.
Regardless of why that occurred is sort of outside the realm here. Okay, for the moment. The trick is that the balance in that cash account is still $10,000, right?
Right.
Okay. Now let's convert that to accounting. On accounting, when we're talking about cash, remember, cash is an asset. It's on the left-hand side of the equal sign. So it's going to go up on the left and down on the right.
Okay.
Okay. So now when we're in accounting, we're going to write it.
Okay, yeah.
You got it?
Yeah.
See, all that debit and credit is doing for you is it's taking this process of a normal single columnar format is much more difficult to keep track of than, believe it or not, than a 2-columnar process. Because the 2-columnar process, we can go, okay, well, there's 13,000 minus 3. And we get 10, right? Here, you got to go item by item, right?
Right.
The other thing is when we write our journal entries, right? So now let's talk about why. Okay, so this $10,000 right here, right? That would be a debit to cash, We know that journal entry has to balance, so we know that we got to have a credit there, right?
Right.
So now the question is, what's the credit for? Did we earn revenue? Well, if we did, we put it in revenue, right? If we collected cash, maybe we sold a building. So the credit would go to building, reducing the building account. Maybe we got that cash by borrowing money from the bank. So it's a notes payable.
Okay. Yeah.
You getting the idea here? So now, one of the things on the exam, and here's the trick of picking up some points. Okay. I always, in my lectures and stuff, I'm like, always go for the gimme. Okay. Because most people can get the fact that cash goes up on the left and down on the right. Okay. The trick is that you know that this journal entry has to balance. So even if your brain goes blank on you on that journal entry, make sure you've got cash, right? Make sure you got that debit, and make sure you go ahead and plug the credit in.
Okay.
You just went from 50% of your points to 75% of your points, and now you went from failing to passing.
That makes sense.
You got it?
Yeah.
Okay. So one of the big things to really make sure of is do not quit too soon. Okay. Make that journal entry balance no matter what. Okay. All right. Okay. All right. So we good on that first round through.
Yes.
Right. This is all it can be, right? Those journal entries just have to balance.
Right.
Okay. So that happens on a daily basis. Round 2, we're now at the end of the month. Okay. The only thing that we've been doing all month long, recording cash receipts, recording cash disbursements, billing customers, and recording invoices from vendors. Now we get to the end of the month and we've got to adjust balances to make sure that they are all correct. Okay. So the first thing that we're going to do is we're going to start on the asset side of the balance sheet. Okay. The asset side of the balance sheet, right? We've got those prepaid assets like prepaid rent, prepaid advertising, prepaid insurance. Did we use some of that? If we did, we've got to take it out of the prepaid asset and put it into rent expense, insurance expense, advertising expense. Okay. If we had previously purchased supplies and we've now used some of those supplies, now we got to take it out of the supplies and put it into supplies expense. If we sold inventory, and this one we won't get to until chapter 6, but if we sold inventory, we'd have to take it out of inventory, and that goes into a special expense account called cost of goods sold. Okay. But this is the one that we're dealing with in chapters 2 and 3. Actually, this is in chapter 4. My bad. Okay. Does that make sense?
Yes.
All right. So as we're moving down that asset side of that balance sheet, right? We're seeing cash. We're seeing accounts receivable. We're seeing those prepaid expenses. We're seeing inventory. We're seeing supplies. Then we start to get down to some of those long-term assets. All right. So when we get down to the bottom where we've got these long-term assets, where we've got things like automobiles, buildings, equipment. Now those types of assets, we're going to have to appreciation expense on those tangible assets that we can see, touch, taste, smell. Okay. Then they've actually brought up the whole idea of amortization. Okay. We'll get deeper into that in a later chapter. But when you've got things like copyrights, trying to remember what some of the other ones are. What are the ones that he's brought up? We've got copyrights are one. I think software licenses has come up already. Those types of things are what we call intangible assets because there's real no physical substance to it, right? Software licensing, I mean, there's zeros and ones on a, hardware server somewhere, right? So those types of things get what we call amortization, which functions just like depreciation. It's just an allocation of a long-term asset, okay? Now, when we'll get into fixed assets more in, I want to say chapter 8. Okay, but
is another example of amortization. Is it like, what about like music? Like if someone's doing music.
Yeah. And we've actually had some really interesting things selling here lately. Trying to think. One of the ladies from Fleetwood Mac, I can see her just as plain as day. She sold, Stevie Nicks, sold her music library for like $100 and something million.
Wow.
2-3 months ago. Yeah. So the folks that now own her music library are now thinking about some amortization. Okay.
Right.
All right. So how are we doing here? So at this point, right, these are all assets that are turning into expenses. You see it?
Yes.
In 1, 2, and 3. You see the pattern?
Yeah.
These are all assets turning into expenses, right? Even though we're not actually hitting the asset down here in depreciation and amortization, we are creating these contra asset accounts that are reducing the book value of those assets.
So this is them going from like prepaid to what they're the expenses because they've been used or whatever?
Correct.
Okay.
Okay. All right. In 4 and 5, or especially, well, let's look at 4 first. All right. So then in 4, now we're over on the liability side of the balance sheet and we're looking at deferred revenues. Have we redeemed any of those gift cards? Well, if we have, we got to get it out of deferred revenue and into sales or service revenue, just depending on what the gift card was redeemed for. Did they come in and use it to buy services, or did they come in to use it to buy product?
Wait, what?
All right, let's back it up. Okay, remember, up here, right, in number 1, we collected the cash and we recorded the deferred revenue, right? Somebody bought a gift card from us.
Okay.
Right? So now, has anybody used those gift cards?
Oh,
well,
okay.
If they have, then we got to get it out of deferred revenue and into sales or service revenue.
Okay.
Right.
Yeah, and we determine whether it's sales or service revenue based on what they used it for, right? If they bought, let's say we're the Apple store, right? Did they use the gift card to buy an app? Then that would be service revenue. If they used the gift card to buy a set of headphones, It's sales revenue.
So for deferred, it means like in the future, and now it's just kind of like we skipped ahead to the future and we're changing it to revenue because it's current.
Correct. So you get the idea here. Well, where'd my mouse go? There we go. Deferred, right? Deferred means to put off. The piece of the revenue that we're actually putting off is actually getting it onto the income statement when we've earned it.
Okay.
Okay. All right. Okay. All right. Now let's look at item number 5. All right. So now let's think again, patterns, recognize the patterns in items. When we get down here to our month-end journal entries, pattern for 1, 2, and 3. These are all recorded assets that are now becoming expenses. In 4, this is a recorded liability that is now becoming revenue. Okay. So you saw an asset first or a liability first. The asset became an expense. The liability became revenue. Okay. In 5 and 6, now we're looking for things that are expenses that haven't been recorded yet. Okay.
Wait.
So
how did a liability become revenue?
Well, the liability became revenue because they bought the gift card first.
Okay, sorry.
Yeah, you see it, right?
Yeah.
They bought the gift card first, and then they used it.
Okay, thank you.
Okay, all right. So again, you saw the assets become expenses. You saw the liabilities becoming revenue. And number 5 and 6, now we are looking for expenses that we've actually incurred but have not been recorded yet. Okay, so in this first journal entry, we may have purchased an asset that we haven't been billed for yet. Now, regardless of the fact that the vendor hasn't billed us, means nothing. We have possession of the asset, so we have to record the asset and we have to record the accounts payable. So in this type of scenario, maybe we bought a copier and we bought the copier on credit at Office Depot, but we haven't received the credit card bill yet. Doesn't matter. We've still got to record that asset and record that liability because we owe them for the copier. Okay. All right. Some type of expense that we've incurred, but again, we haven't received the bill for it yet. An example of something like that would be, we flipped on the lights today. We used power. We owe Duke Power. So we should be recording a utilities expense. But Duke Power is not going to bill us until next month. That's okay. We estimate how much power we've used and we call it utilities expense. Same thing with Piedmont Natural Gas, right? We had hot water this morning when we got in the shower. We used natural gas. So we owe Piedmont Natural Gas, but they're not going to bill us until next month. Maybe trash pickup. The trash company came out, picked up our trash, and they're not going to bill us till next month. Maybe the yard guy came out and cut the grass, but he's not going to bill us until next month.
So basically, we're using the resources or the services that they're allowing us to have, but I'm getting tongue tied. But the expense is not going to be taken out until like its proper date. So what do you call that again?
Okay. Well, hang on one second, because I think we're so close to a light bulb moment with you. Hang on one second. There is. All right. If you go out to Blackboard, I believe it is coursework. It's unit 1. And I think it's chapter 3. Right here under begin with reading, you've got the PowerPoint slide deck. If you open up that PowerPoint slide deck, let me see. It is, oh, there it is. Oh, I love these. There are 2 slides in this slide deck for, what did I just tell you, chapter 3? Yeah. In the slide deck for chapter 3, it's slide 25 and 26. Okay. Let me do a slideshow. Okay. Think about what's happening here. This is a different way of looking at what we're looking at. Okay.
Okay.
If we're looking at revenues first, okay. Now, keep in mind that there's a couple of there's 3 different ways that we can do this, and it really is that's it. When we're talking about revenues, there's only 3 ways that we can sort of close the loop on revenues. Somebody comes in and buys a gift card and then uses it later.
Okay.
So we collect the cash first and then we earn the revenue later. Okay?
Okay.
All right. Here, we collect the cash and earn the revenue at the same time. Here, we earn the revenue first and collect the cash later.
Okay.
You see the differences?
Yeah.
And these journal entries that's it, right? We collect the cash first, we record the increase in cash, we record the deferred revenue. Right? This is sitting out here as a liability sheet. Now they've actually redeemed that gift card, used it for something. Now we got to get it off the liability and into revenue, sales or service, just depending on what it is.
Okay.
Here we're doing it. Both things are happening at the same time, so it just only takes 1 journal entry. Down here we earn it first, so we got to get it on the income statement as earned revenue first, then we collect it later. Right? So there's revenues. All
yeah,
right?
I think B is easier, but you know.
Yeah, well, exactly. But think about this though. Let's look at this one. Okay. B, this whole idea of collecting cash at the same time that you're earning revenue. Think about, every time you go into Best Buy and you buy something at Best Buy. Now, you're going to have to work with me just a little bit here, but think about this. When we are at Best Buy, right, they're not going to let us out the door without taking some form of currency, transaction, credit card, something, right?
Right.
They're not going to let you out the door on your good looks, right? So
right.
So think about it, that's Best Buy. Think about it in the same way that at the Harris Teeter, right? They're not going to let you out the door without providing them some sort of payment. The corner store, right? They're not going to let you buy gas and a candy bar and a bottle of Coke without getting them some sort of currency or something in return, right? Okay, so that's how those businesses work. Okay. Let's say that you are Duke Power, Piedmont Natural Gas, something like that, right? Our customers use our product first, and then we bill them and we collect later. The customers use more product, we collect later. They use more, we collect later, right?
Right.
So that's how those work, all right? Then think about the insurance companies, right? The insurance companies, they collect those premiums first and then provide the service.
Okay.
Collect 6 more months worth, provide the service, right? So it's really more just how the business model works. Okay?
I get it.
All right? Okay? So then you've got expenses. Same exact type of thing here, is just on the expense side. Okay. Now, On this one, right, on the expense side, we would collect the cash first. Well, excuse me, we pay out the cash first. We would record the prepaid assets. So that's the rent, the advertising, the insurance, right? And then we pay for it first, and then we use it later.
Okay.
Right?
Right.
Sometimes, right, the example that I used here where we pay for it and use it at the same time is when we sent our guy to the gas station with his pickup truck, and he bought gas and had to pay for it at the same time he bought the gas, and he's going to use it immediately.
Okay.
Right?
Right.
Then the other thing that we've got here is here we can buy things on credit and then not have to pay for them until sometime later. So this one is utilities. So this one is from the expense side where we're actually using power, using natural gas, using the landscaping service, and then we're having to pay for it later.
Okay. Yeah.
So these two slides right here are beautiful summaries of how that stuff works. Okay. I'm just doing it in a little bit different format because I'm trying to get you to see what we're doing in the accounting department. I just look at it from a different perspective, right? I'm looking at, we've bought some kind of asset, or we've, used some kind of expense. We've got to record the payable, right? If we, so this is from the asset and expense side up here. If we keep rolling down the balance sheet, again, I'm just kind of working my way down a balance sheet. If I see a note payable outstanding, we've got interest expense, right? Unless the interest rate is 0, right? We've got interest expense. We got to record that interest expense. Okay, we may pay, we'll pay that interest expense next month, but we got to get it recorded this month because it was incurred this month. Salaries and wages. Salaries and wages are calendar. Think about how this works, right? Most people's pay week runs from a Sunday to a Saturday, right? And then you get paid the following Friday. So if we're sitting here at the end of February, and think of this from the business's perspective, everybody has showed up the 21st through the 27th, but we're not going to pay them until the 5th, right? Everybody showed up for work in February, but we're not going to pay them till March. We got to get that expense, that payroll and salaries expense recorded in February. If we wait until the day that we pay it, it's going to go in March. And it belongs in February.
Right.
That's what we're doing here. Then at the one last entry that we're going to make at the end of every month is we're going to have to determine income tax expense. So that's going to be, this one right here is going to be the very last journal entry at the end of every month when we sort of determine what our real net income is. Okay.
Okay.
All right. So this right here in number 5, this was accrued expenses. This one down here is accrued revenues. So about the only thing that we can accrue as revenues at the end of the month is we provided service to somebody, but we haven't billed them yet. So along those same lines, everybody goes out and provides the service from the 21st to the 27th, but it takes us all the next week to get our billing together, and we get every up here because we provided the service, not in March when we bill it. So this journal entry right here gets it into February right there. Okay. The one other thing that they had that I haven't even brought up yet is they did bring up the concept of a note receivable where we actually loaned out money. to, I think it was an executive or an employee, if that note receivable is outstanding, we've got interest revenue. Because hopefully we didn't loan it to them on a 0 interest rate.
Okay, that makes sense.
Okay. All right. So then that's the journal entries at the end of the month. Now, now again, keep in mind, 1 through 4 up here, that's chapter 2 and 3. Okay. Round 2, this month end stuff, all of these adjustments down here are chapter 4. Okay. And then again, round 3 is also chapter 4, where we're closing the revenues, expenses, and dividends. Now, this is one where don't make this one hard either, because, right, we record dividends, go back to here, right? If we've got, right, if we record dividends, right, dividends go up with a debit and down with a credit. So if they go up with a debit to close them out to 0, we need a credit, right? If we, as dividends are going up, we close it out with a credit, we're reducing retained earnings with the debit for that journal entry. You see it? So when we close dividends, we roll it up to retained earnings. And this debit right here to retained earnings is going to reduce retained earnings. Then we close out our revenues and our expenses within the same journal entry. And again, we're either going to debit retained earnings or credit retained earnings for the net difference between these two. So again, to force this journal entry to balance, we would, if we had net income, we would roll up the net income to retained earnings with a credit, right? Because credits increase retained earnings. If we had a net loss, we would roll up the net difference between the two with a debit, which would actually reduce retained earnings. Okay. Now, that being said, think about how this statement of retained earnings works. Beginning retained earnings plus net income minus dividends, right? When we close dividends, a lot of information, isn't it? How we doing?
Yeah, it's a lot.
It is a lot. I'm sorry, Rachel, what?
It's kind of overwhelming.
Well, here's the thing. Don't let it be overwhelming, okay? On the exam, the biggest thing that you're going to do is this part 1, because we did need to sort of go over part, our round 2 and 3 with chapter 4. But keep in mind, on the exam, the only thing that's going to be on the exam is cash receipts, cash disbursements, billing customers, recording invoices from vendors. So again, if we received the cash, what was it for? If we paid out the cash, what was it for? We bill the customers, it's the same journal entry every time. If we bought something on account, what did we buy?
Okay.
Right?
Yeah.
So it's just those 4 things.
And does that include the net income at the end or no?
What do you mean by that?
Because I know with some like income statements and that kind of stuff, it has like the net income at the end that you have to like do the revenues minus expenses to get the net income. Will that also be included in this, or is
Okay,
that?
yes, it could be, but keep in mind that on this first exam, we're dealing with unadjusted balances. So any net income that we calculate on this exam is going to be, call it a preliminary net income.
Okay.
When we get into chapter 4, that's when we made the adjustments. We got those really nice, good numbers after the adjustments, and we got a finalized net income number.
Okay.
Okay.
Yeah, that makes sense.
Okay.
And the question that we should ask with the what was it for, does that correlates with what you were talking about earlier when you went to that other PowerPoint with the service being handled after the payment and the service being handled before the payment? Is that what you were talking about? With that, yeah.
Yeah,
Okay.
a little bit. Because again, in this one, they're just simply looking at, we had a cash receipt here, right? What was it for? Well, in this case, we sold a gift card, right? This one is from chapter 4. So this one could be a valid journal entry for this first exam.
Okay. Yeah.
This one, right?
I'm sorry.
Now, I was just going to say, whoop, right? I was going to say this one, right? We collected cash, and this one we had to record some kind of sales or service revenue. Right. This one is in, let's see, this entry is chapter 3. This entry right here is chapter 3. This entry right here is chapter 3. So keeping in mind that out of all 3 of these items, this one, this one, this one, and this one are fair game. This journal entry right here is a month-end adjustment. So this doesn't occur until chapter 4. But okay, any of these other ones are fair game. Okay. Same thing here, right? On the expense side, this one, this one, this one, and this one, all fair game. That's chapters 2 and 3. This journal entry right here is an adjustment from chapter 4.
So I get the concept of like you pay before the actual service or whatever, and then you pay at the same time, or you pay after the service has been completed. Do they have names? Like, is there vocab we need to remember for those specific?
Yeah, I was asking that. Yeah.
Or is it just implied?
They may tell you, well, let's see. Over here, keep in mind, over here, it's either sales revenue or service revenue. Okay. So if we're selling product, it's got to be sales revenue. If we're selling time, it's got to be service revenue. So on the revenue side, there's only 2 options, sales or service revenue. Okay. And they are going to expect you to understand, like, you know, doctor provides service. So that's going to be service revenue. Sold a product, that's going to be sales revenue. Okay. So the context of the question is going to have to, you know, help you determine which is which. Okay. Now down here, they would have to tell you what are we buying and what are we using? Did we buy supplies? Was it utilities expense? They could say something like, we used power for this month of $500, but they don't necessarily tell you that you need to charge it to utilities expense. You just have to understand that power goes to utilities expense.
Yeah.
But things like advertising, rent, insurance, those kinds of things, I think will be pretty obvious as to what you need to charge it to. I'm trying to think if there's anything else that could be a little weird. They might say something like, we paid employees or we paid employees, and you have to know that it is salaries and wages expense. Or they might say, let's see, hang on. No, because that would be chapter 4. Yeah. So that could be a situation. We paid wages, or we paid employees. So you just have to know that it's salaries and wages expense.
Okay.
Trying to think what else.
Oh, and I remember from the first, I think it was in the first 3 chapters. On some of them, like the income statement, I couldn't figure out which ones were like at the end of the month, or like they have a longer one that's like for the month end or something. Like there's a difference between the two, but I couldn't figure out how to differentiate.
Okay. All right. Here's a couple of things. The income statement is going to indicate a time period. So it's going to be 4-month end, 4-quarter end, 4-year end. Okay. Because you're going to start totaling up revenues and totaling up expenses come, January 1, and you're going to give us totals all throughout the year. So the income statement covers a time period. So that's when it's going to say 4-month end, 4-quarter end, 4-year end. Okay. Same thing with a retained earnings statement, because that net income number and that dividend number, those two numbers are covering a time period. So again, the retained earnings statement is going to be 4-month end, 4-quarter end, 4-year end. Okay. A balance sheet, the date is going to be an at, because if you think about it like this, when let's say that you totaled up everything today and you gave me a balance sheet today. The first time you write a check tomorrow, the first time a customer walks in and buys something from us, those numbers change. Right? The first cash receipt that you make tomorrow makes that cash balance on the balance sheet today different.
So it's basically when the payments are happening, essentially? Like when the cash flow changes?
When any of the balance changes. So yeah. So I mean, technically, if you want to get real picky with it, a balance sheet could change 1,000,000 times a day after every single transaction. Because every single time you accept cash, your cash balance no longer, your actual cash balance no longer matches what is on the accounting records or the financial statements.
So it says at because it's not like just one set date the way that the income statement and the revenue is?
Actually, you got it backwards. The income statement and the statement of retained earnings cover a time period from one date to another. A balance sheet is literally at a specific date, and it's at the basically it sort of implies that it's at the end of the work day. But we just don't put a time on it.
Thank you.
Because those balance sheets would change every day. So it balance
Hello? Hello?
Are you still there?
Oh, I thought there was something wrong with my with my volume or something.
No, I think her Wi-Fi went out again.
Oh.
Uh-oh. Uh-oh. Hang on. Can you hear me yet?
Yeah, we can.
Oh yeah.
There we go. Okay. Sorry. I got to tell you, it's amazing to me that my Wi-Fi can't go out because I've got like turbo internet. So anyway. All right. Okay. Any other questions?
We have a homework assignment that's due tonight, right?
Hang on a minute. Let me flip over ACC120. Today is Wednesday. Yeah, you had chapter 5 homework that was due as well.
Okay, I have to do that.
Well, let me say this. If you have not done the exam, make the exam your priority, but go into chapter 5, open the homework, put something in there. I don't care how little, because here's the trick. When you finish up homework, you can always go back into homework after the due dates and times, and it will tell you at the top of the screen, there'll be a little button up there that says show correct answer, and then it'll toggle on and off between show correct answer and show my answer, and it will give you the detailed information of what the correct number is and how to get it.
Okay.
The correct number.
Oh.
The trick is though, is that if you don't open the assignment and do anything in it, it won't allow you to go back and do that later.
Okay. I've
So,
opened.
and keep in mind that you do get one drop you get one drop to Learn Smart, one dropped homework, and one dropped quiz. So, yeah. So make the priority the exam. That exam is 15% of your grade. You do not want to, yeah.
This exam is, or all of them?
No, this exam is 15% of your grade. And it's due at midnight.
Jeez Louise.
That's a lot.
Yeah. So I'm gonna say, you know, no, for real. I'm gonna say, I'm going to do my level best. But hypothetically speaking,
don't ask me for a curve before the exam.
Oh no, I'm not gonna ask you. I'm not gonna ask you for a curve. but like say for instance, if like I pass but barely, would that, well, I wouldn't ask it because I don't even think you would know. I'm just gonna do my level best.
Would it drop it down a letter grade?
If you made a 0, it is possible that your grade could drop by 15 points.
Well, at this point, with the way my grades is, I don't need any more of that. So,
well, let me just say this, okay? You'll be this semester is the first semester that we have that we've done this 8-week session during a like fall or spring semester. Yes. Let me just say that you're not alone. That's all I can say.
Okay. You don't know how comforting that is right now, but
Yeah, well, I'll tell you more, but I just know that if you associate this comment with me, I will track you down and hunt you down like a dog.
Okay.
We weren't the accounting faculty was not given a choice.
Oh. Okay.
Yeah. When we all looked at the schedule for spring, we were all going, "What just happened?"
Yeah. Because when I got the email, I thought this was like a course that we were going to like be in classes, but social distancing.
Mm-hmm.
And then I got an email saying, "No, we're online," and I'm like, "Ooh."
Yeah. I didn't know that it was a short session class. Like, it didn't tell me until after I had already signed up and paid.
Facts.
Yeah.
And I have 2 classes that are like that. My intro to business class is the same way. So I have like a ton of assignments each week, and the dates keep changing. So it's really hard to keep up with everything.
Well, I will tell you, we fought as hard as we could. Let me just say it that way. We fought as hard as we could for you guys and went, you realize they're going to
struggle,
flip out, right?
Right.
And you know, because the whole thing is I mean, because well, let me just say it this way. I've got one student who started out classes, and right now she's got 3 other classes other than this one.
Yep.
That she's taking, and she's got a full-time job.
Dang.
I've been there.
Yeah. And
Still
she's
there.
like, and she is struggling. And we were very concerned that this kind of stuff was going to happen, and they have tried to do and accommodate as much as they possibly can, but I think this semester is going to be a well, we tried that.
Yeah.
Oh yeah.
It's because I've been put on like Brightspace with this, like with 2 other classes, and I have like microeconomics, and it's like everything is different, and I keep getting stuck with the groups of like where they're trying new websites, trying new stuff, and I keep getting that, and it happens over and over again, and then I keep having to struggle through it, and then I'm like, and then after they're like, "Oh, we shouldn't do that to the next students." So it sucks because it keeps happening to me.
Wow. So like,
well, can I just say, put that type of information on your course reviews.
Yeah.
Because we do read those.
Oh, okay.
Yes, we do. So that's the kind of stuff that we need to know about, because you know, we can't do anything about it unless, you know, somebody is saying something, and you know, unfortunately it's one of those things where if you don't say anything, we assume that everything's okay. Yeah,
I put it in my last review that I didn't really like Brightspace because that's the new website, and
right.
This semester I got stuck in 2 more classes that are in Brightspace, and I've had multiple assignments that I don't know. I don't do all the work for it, and I don't know because it's got so many different like tabs you click on, and like the information is hidden. So it's very frustrating. Well,
I will tell you that unfortunately you're going to see more and more Brightspace, because come fall, every class is going to be in Brightspace. So we are finishing up with Blackboard, and every class is going to be Brightspace in the fall.
What?
Well, luckily I'm graduating this semester.
Wait. And I'm not. So this is some mean business, because Blackboard, I feel like Blackboard was really good.
It is.
And I don't understand the change the necessity of the change. I mean, Blackboard is really accessible, and I've been with CP for a couple of semesters, so I kind of got the feel of Blackboard, like, and so it's really a disadvantage if you constantly are changing certain things like that.
I'm just gonna leave that with an amen, brother.
Wow.
I hear ya. I really, really do.
Yeah, the first time I had it was I was like the group that was the experiment before they announced that they were going to change it. And it was a biology class.
Okay.
It was horrible.
Oh my gosh. So
well,
wait.
I gotta tell you, this has been really interesting to hear you guys say this stuff.
Oh wow.
Yeah.
But I think on some level, they've been planning this. They call it a LMS or a learning management system. They've been planning on this for years. Personally, I think what would have been an appropriate thing to do was to delay the change.
Yeah.
Simply because I don't know about anybody else, but I think we're all in change fatigue mode at this point. So,
yeah. It's very overwhelming, like having the pandemic and then having all this change with like I'm on like so many different websites for each class, and it's a lot. And I just think I should have just stayed with Blackboard for a little bit longer.
Yeah, I agree.
Well, while we got it, we can we can still use it, but wow, I'm glad that you guys told me now, so I can kind of prepare myself.
Yeah.
For what's to come.
Yeah, more and more. So probably during the summer, a few more classes will go online, and then all the accounting goes online in Brightspace. So
yeah.
Yeah,
I was thinking of staying at but then I changed my mind when I found out that they're changing it all the way to Brightspace.
Wait a minute, you changed your mind about what?
About staying at CPCC for a little bit longer. I decided to just graduate once I got my credits to get back. Yeah. So that wouldn't happen.
So are you transferring to another 4 years college or?
Yeah, I'm going to UNCC for international business.
Oh, okay.
Yeah, I wish I could, but unfortunately I have another year, because I went part-time. So
yeah.
Well, let me just say that the faculty, no, we do.
Yeah.
And we know. So we're trying to get the message to anybody who will listen.
Right.
Yeah.
Well, I'm gonna log out because it's 8:12 and
all right.
Yeah.
You have 1 hour and 15 minutes to cram everything in and then open that exam.
Yeah.
What's helped to do the practice, like the self-study on the textbook? Like those questions, will they help at all, or should we just focus on?
Right there at the end of every chapter, if you haven't found it, hang on a minute. Let me show you one quick little thing. Dadgummit, where's my McGraw-Hill? Let me show you one more thing. If you want a really good review,
Okay.
based on everything that we've already done, right? Go into McGraw-Hill, okay? Okay. All right. So in McGraw-Hill, right over here on the left, you've got your ebook. Okay. If you click on that ebook, and by the way, I go over all this in the exam reviews too. So now that you know where the integrity recordings are and everything else, you'll actually benefit from some of this. All the way down here at the bottom, at the end of every chapter, there's a demonstration case based on everything that you did in that chapter. There's a chapter summary. There's key terms. There's a homework helper down there that says, that basically says, here's the most common mistakes that are being made. And then there's a little multiple choice quiz. And every single, that little piece right there is at the end of every chapter. And would be a nice little thing to maybe spend 15 or 20 minutes in each chapter, and then open up that exam and go.
Okay, so wait, how do you get to that again? You go to the
when you're in the McGraw-Hill.
Okay.
Okay. You're at the front page of McGraw-Hill. Over here on the left-hand side of the screen where it says read.
Right.
You should see the book and it should say ebook.
Okay.
When you click on that ebook, this pops up.
Oh.
And right here, the table of contents, right? Each one of the chapters is there. Just click on your chapter, scroll down, and it starts right here. Review the chapter, demonstration case, chapter summary, key terms, homework helper. So, and this little multiple choice thing right here, this is just a little multiple choice quiz that you can click on the answer and the answer pops up, so you can sort of test yourself a little bit. Now, so that might be something good to, as your last thing that you review. But that demonstration case is really good, right? Because it shows you, this is the data that you're starting from. Prepare an income statement. There's your income statement. There's your retained earnings statement. I mean, it gives you the answer, right? Here's your balance sheet. Here's how it flows through, right? Here's your chapter summary with all your learning objectives. Here's your key terms. Here's your homework helper, right? And then that quiz. But you got to click on that quiz separately for that to come up.
Okay.
Yeah, but that's at the end of every chapter in your ebook.
Okay.
And in your actual printed textbook as well.
Oh, yeah. Okay.
Okay.
All right, well, guys, Professor, thank you so much. And
you're very welcome.
My very last question is, more WebExes like these. Do you do this weekly every Wednesday around this time?
I actually do it every Tuesday at 11, and then every Wednesday night at 6.
Wednesday night, Tuesday. If it's 11 a.m. because of my work hours, I'm not able to make it to that one, but I will definitely tune in to 6 Wednesdays.
Yes. Yep. I do this every Wednesday night at 6.
All right. Well, I'm heading out for real. Okay. Talk to you guys later.
Well, let me just say this. Breathe deeply. Your brain likes oxygen. And just do the best that you can. That's all anybody can ask.
Right.
And then after the exam is over, we can talk if you don't like your grade, and we can get a plan together on how to recover. Okay?
Okay.
Thank you.
All right.
Much.
Yep. You're very welcome.
All right.
Y'all have a good evening.
You too.
Bye.
All right. Bye.
Bye.